Credit card debt, the most common type of debt. Credit card debt happens when you borrow money through a credit card and don't pay it off in full by the due date. Let's say you spend $500 on your card. If you pay it back that same month, you're fine, no interest. But if you only make the minimum payment, the rest carries over to the next month, with interest. And credit card interest is very high, often 20% or more. That means a $500 balance could turn into $600, then $700 if you don't pay it down fast. Credit cards are a form of revolving debt. You can borrow, repay, and borrow again. There's no fixed timeline. That's what makes them flexible, but also dangerous. The good, great for building credit if used responsibly. Offer rewards like cashback or travel points. Useful in emergencies. The bad, high interest rates. Easy to overspend. Can hurt your credit score if you carry high balances or miss payments. Most people get into trouble by using credit cards to buy things they can't actually afford, then only making small payments each month. The key? Treat your credit card like a debit card. Spend only what you can pay off in full and avoid interest altogether. Student loans. Borrowing money to buy an education. Student loans are used to pay for college or vocational school, covering tuition, books, housing, and more. They're one of the few debts people take on before they even have income. There are two main types: federal student loans issued by the government, private student loans issued by banks or lenders. Federal loans usually have lower interest rates, income-based repayment plans, and forgiveness options. Private loans have fewer protections and often higher rates. Most student loans don't require payments while you're in school, but once you graduate, you enter repayment. Interest builds over time, especially if you borrowed a lot. It's not uncommon to graduate with $30,000 to $100,000 in debt, depending on your degree and school. The good? Allows access to education you couldn't otherwise afford. The bad? Can take 10 to 25 years to pay off. Can't usually be discharged in bankruptcy. Student loans are often called good debt because they're tied to education, but only if your degree leads to income. So before you borrow, always ask, will this degree help me afford the debt I'm taking on? By the way, I'm going to be posting a lot here, so it would mean a lot if you subscribed and dropped a like for the algorithm. Auto loans. Financing a car with interest attached. Auto loans are used to buy a car when you don't want or can't afford, to pay the full price up front. Instead, you make a down payment, then borrow the rest and repay it over time, usually 3 to 7 years with interest. Let's say you buy a $25,000 car. You put down $5,000 and finance the remaining $20,000. Depending on your interest rate, you could end up paying $23,000 or more by the time it's fully paid off. Auto loans are a type of secured debt. The car itself is the collateral. If you stop making payments, the lender can repossess the vehicle. Your interest rate depends on your credit score. A buyer with excellent credit might get 3% interest, while someone with poor credit might pay 12% or more. The good. Makes reliable transportation affordable. Can improve your credit if paid on time. The bad. Cars depreciate fast. You can owe more than it's worth. Missed payments hurt your credit and can lead to repossession. Long loan terms mean you pay more in interest. Many people stretch their budget to afford a nicer car. A smart auto loan keeps your payment under 15% of your monthly income, and the loan term as short as possible. Mortgages. The biggest debt most people will ever take on. A mortgage is a loan used to buy a home. Homes are expensive. A typical house might cost $200,000 to $500,000 or more. Most buyers don't have that kind of money up front, so they make a down payment and borrow the rest from a lender. That mortgage usually lasts 15 to 30 years. Each month, you make a payment that covers principal, the amount you borrowed, interest, the cost of borrowing, plus property taxes and insurance depending on the loan. Mortgages are secured debt. Your home is the collateral. If you stop paying, the lender can foreclose and take the house. The good lets you own a home without paying the full price up front. Can build equity as the home's value increases. The bad, long-term commitment. Interest adds up to tens or hundreds of thousands over time. Mortgages can be a smart investment, but only if you buy within your means and understand the true cost over time. Personal loans, borrowing money for almost anything with no strings attached. A personal loan is a lump sum of money you borrow from a bank, credit union, or online lender, and pay back in fixed monthly payments over a set period, usually 2 to 7 years. What makes personal loans different? They're usually unsecured, meaning there's no collateral. You don't have to put up a car or house to get one. That means the lender takes on more risk, and you'll usually pay a higher interest rate than secured loans. You can use a personal loan for almost anything. Let's say you borrow $10,000 at 8% interest over 5 years. You'll pay about $200 a month and nearly $2,200 in interest by the end of the loan. Rates vary based on your credit score. A high score could get you 6 to 8%. A low score might mean 20% or more. The good? Flexible use, predictable fixed payments. The bad? High rates for bad credit. No safety net, missed payments hurt your credit. Personal loans can be a smart tool when used responsibly, especially for consolidating high-interest debt. Medical debt. Unexpected and often unavoidable. Medical debt happens when you receive healthcare services you can't fully pay for, like surgeries, hospital stays, or emergency treatments. Even with insurance, you might still owe deductibles, co-pays, or out-of-network charges. And without insurance, a single visit can cost thousands of dollars. Unlike most debt, medical bills often aren't planned. But here's the thing. Medical debt is treated differently than other debt on your credit report. As of recent policy changes, most medical collections under $500 no longer appear on credit reports. Paid medical collections are now removed. Still, unpaid medical bills can damage your credit, lead to aggressive collection calls, and cause long-term stress. The good, often negotiable. You can ask for discounts or payment plans, usually interest-free if handled early. The bad, can appear on your credit report if ignored, easily grows out of control. Medical debt isn't a sign of bad choices. It's often a result of a broken healthcare system. Payday loans. Fast cash now, crippling debt later. Payday loans are short-term, high-interest loans meant to carry you from one paycheck to the next. They're often marketed as a quick fix for emergencies. You borrow a small amount, say $300, and agree to repay it in full, plus a fee, usually within 2 to 4 weeks. But here's the catch. That fee is basically sky-high interest. A $45 fee on a $300 loan may not sound like much, but over a year, that adds up to an APR of 300% or more. And if you can't repay the loan by your next payday, many lenders will roll it over into a new loan, adding more fees and trapping you in a cycle. This is how payday loans turn $300 into $900+ in debt, fast. The good, fast approval, often no credit check, can provide quick cash in emergencies. The bad, extremely high interest rates, short repayment windows, easy to get stuck in a repeat borrowing cycle, often target low-income or desperate borrowers. Payday loans are legal in many states, but heavily criticized, and escaping them is harder than getting in. Buy now, pay later. Easy payments now. Debt hiding in plain sight. Buy now, pay later lets you split a purchase into smaller interest-free payments, often over 4 to 6 weeks. You'll see it when shopping online. Pay in 4 with Affirm. It sounds simple. Buy a $200 item today, pay $50 now, and pay the rest in 3 more payments. No interest, no credit card needed, no problem, right? Not always. BNPL is debt, even if it feels invisible. If you miss a payment, you may get hit with late fees, interest, or collection notices. The good? No interest if paid on time. Quick approval, no credit required. The bad? Encourages impulse spending. Missed payments can hurt your credit. Easy to lose track of multiple loans. BNPL is growing fast, especially among younger shoppers. But just because it's frictionless doesn't mean it's harmless. Home equity loans. Turning your house into cash. A home equity loan lets you borrow money using the equity in your home as collateral. Equity is the difference between what your home is worth and what you still owe on your mortgage. For example, if your home is worth $300,000 and you owe $200,000, you have $100,000 in equity. A lender might let you borrow up to 80% of that, so you could get a loan for $80,000. You receive the money in one lump sum and pay it back over time, usually with a fixed interest rate and monthly payments. The good, lower interest rates than credit cards or personal loans. The bad, your home is collateral, miss payments, and you could lose your house. Home equity loans can be smart if you have strong equity, a solid repayment plan, and need a large sum at once. Title loans. Fast money, secured by your car. A title loan is a short-term, high-interest loan where you use your vehicle title as collateral. Here's how it works. You hand over your car title and the lender gives you a loan, usually a few hundred to a few $1,000s. You keep driving your car, but if you don't repay the loan, the lender can repossess it. These loans are fast and easy to get. No credit check, no waiting, just your title and an ID. But they come with a serious downside, extremely high interest rates, often 200% to 300% APR or more. Most title loans last 30 days or less, but if you can't repay in full, the lender may let you roll it over into a new loan, adding more fees and more interest. The good, fast approval, even with bad credit. No restriction on how you use the money. The bad, huge interest rates, short repayment windows, high risk of repossession. Title loans are marketed as a quick fix, but they can quickly spiral into long-term financial damage. Because once your car is gone, getting to work and earning money gets a lot harder. Cash advances. Borrowing cash at credit card interest. A cash advance is when you use your credit card to get cash instead of making a purchase. You can do it at an ATM, a bank, or even online. It's fast and easy, but also very expensive. Here's why. Cash advances don't come with a grace period. Interest starts immediately. No waiting until the due date like regular credit card purchases. The interest rate is usually higher, often 25% to 30% APR. You'll probably pay a fee of 3% to 5% on the amount you take out, sometimes more. So if you withdraw $500, you might pay a $25 fee up front, plus $10 to $15 in interest every month you carry the balance. The good. Fast access to cash. No credit check or approval needed. The bad. Very high interest from day one. Extra fees on top of regular card charges. Cash advances are meant to be short-term tools, but many people get stuck paying them off for months or even years. Business loans. Borrowing money to grow or survive in business. A business loan is money borrowed to start, run, or expand a business. It can be used for nearly anything: buying equipment, hiring staff, covering operating costs, or investing in growth. Lenders look at your business revenue, credit history, and business plan before approving a loan. Some may require collateral, like inventory or property, especially for large amounts. The good. Can help you grow faster than relying on profits alone. Builds business credit. The bad. Can be hard to qualify for if your business is new. High interest rates for short-term or risky borrowers. Defaulting can hurt your personal credit if you signed a personal guarantee. Business loans can be a smart tool when used for calculated growth, but borrowing just to stay afloat or without a clear plan can lead to debt your business can't repay. Lines of credit. Flexible borrowing on demand. A line of credit is a type of loan that works more like a credit card than a traditional lump sum loan. Instead of borrowing all the money at once, you're approved for a maximum limit, say $10,000. You can borrow from it as needed, repay it, and then borrow again. That makes it a form of revolving credit, like a credit card, but with cash access and often lower interest. There are two main types. Personal lines of credit, used for emergencies, home projects, or large expenses. Business lines of credit, used by companies to manage cash flow or pay vendors. Interest is only charged on the amount you actually use. So if you have a $10,000 line and borrow $2,000, you only pay interest on the $2,000. The good. Flexible borrowing. You only take what you need. Lower interest than credit cards in many cases. The bad. Variable interest rates can change over time. May require strong credit or income to qualify. Lines of credit are great for managing short-term needs, not long-term projects. They're best used like a financial safety net, not a spending spree. Debt consolidation loans. One loan to pay off many others. A debt consolidation loan is a single loan you use to pay off multiple existing debts, like credit cards, medical bills, or other loans. Instead of juggling 5 payments to 5 lenders, you combine everything into one monthly payment, often with a lower interest rate and a fixed term. For example, you owe $3,000 on one card, $2,000 on another, and $5,000 on a personal loan. That's $10,000 total. A debt consolidation loan gives you $10,000 in cash to pay those off, and now you only owe the new lender. The good. Simplifies your finances, just one payment to track. May reduce your total interest. The bad. You need decent credit to qualify for the best rates. May come with origination fees. Doesn't fix the root cause of debt, spending habits. Debt consolidation works best when you're done borrowing and ready to get serious about paying things off. Installment loans. Fixed payments, clear end date. An installment loan is any loan you repay over time with regular fixed payments, called installments. That includes common debts like mortgages and auto loans. Here's how it works. You borrow a lump sum, let's say $10,000. You agree to repay it over a set term, like 5 years, with monthly payments that cover both principal and interest. The good. Fixed payments make budgeting easier. You know exactly when the loan will be paid off. Often comes with lower interest rates than revolving debt like credit cards. The bad. Less flexibility. Once you borrow, the terms are locked in. May charge fees for early payoff. Late or missed payments hurt your credit and trigger late fees. Installment loans are great for big, planned expenses, like buying a car or financing home repairs. They give you structure, predictability, and a clear finish line. Open-ended versus closed-ended debt. 2 categories that define how debt works. All types of debt fall into 2 broad categories, open-ended and closed-ended. Open-ended debt is also called revolving debt. This means you have a credit limit and you can borrow from it, repay it, and borrow again. Examples include credit cards, lines of credit. You can use the credit repeatedly as long as you stay under the limit and make payments. But there's no set end date. It's ongoing. Closed-ended debt is the opposite. You borrow a fixed amount up front and pay it back in equal installments over time. Once it's paid off, it's done. You can't borrow more without applying for a new loan. Most people carry both types of debt. Knowing the difference helps you manage them wisely and avoid surprises. If you enjoyed this, I'm going to be posting a lot here, so it would mean a lot if you subscribed. Thanks for watching.